Hello, welcome to Forex School Uganda. Today I want us to share about some of the secrets that you can take to make yourself or turn yourself from a losing trader into a profitable trader when it comes to the trading of financial instruments. The secrets to your trading success, some of the secrets that you can take to ensure that you become profitable when it comes to the trading of financial instruments online. Now, these financial instruments are quite many. That includes currency pairs, indices, commodities such as gold, oil, silver, as well as stock options, futures. There are so many instruments that you can trade online. I want to look at some of the secrets to profitable trading when it comes to the trading of financial instruments online. Number one, you need to have knowledge. Now, there are not two ways about it. Now, this knowledge could be gotten from different mentors, free content online via YouTube, certain websites that you can go to and get some of this knowledge, or you could have someone that you know that knows how to trade that can help you acquire this knowledge, or you could even get it through books. I mean, there's a lot of free content, especially online, in the form of literature as well as video, that you can make use of to get yourself enough knowledge to know at least much about the currency markets, what they are all about. Now, much of it you may be able to trade with it, and if you're able to, you may not even be able to make money with it, but at least it gives you a foundation to know what the markets are all about before delving deeper into the different ways that you can actually harness all this that you have learned, the knowledge that you have gained, to be able to make money with it. Now, number two, once you have acquired the knowledge from the different sources, regardless of what it is, you need to transfer that knowledge to the charts. Now, when it comes to the charts, it's all about study. You need to study the charts. The charts have their own language, which is a technical language. It takes a skill to be able to decode the language of the market, but it's all technical. Now, that will require you taking time. You need to sit down, watch the charts, spend time studying the different moves of price, the different patterns that price forms in the market, the different setups that come up within the market, the different candlestick formations that appear in the market. There's so much to study when it comes to the charts. There's nothing that beats chart time. The longer you look at the charts, the more the patterns come out naturally to you. You tend to see certain repetitive behaviors. Now, such behaviors come in the form of patterns and candlestick formations. And make no mistake, there's nothing new under the sun. And that's as true for the charts as it is for anything else. These patterns are repetitive. The setups in the market are repetitive. Certain candlestick formations are repetitive. And you get, the longer you stay on the charts, the more you realize there are certain familiar candlestick formations or setups that come up in the market, certain patterns. The way that price moves is repetitive. History repeats itself, we've been told, and there's nowhere that is much more truer than the charts when it comes to the trading of financial instruments online. And so you need to spend, just as good as it is to study the theoretical knowledge to help introduce you to what the markets are all about, similarly, it is as important as it is with such to also study the charts and also look at the historical data of the charts until these charts become second nature. And so you will start making out certain patterns and formations and the frequency with which they appear, how they usually play out every time they appear. All this you will get to know that it comes to a point where you look at the chart and you know exactly what price is going to do, where exactly price is going to go, the direction that is coming, the next price moves, that it becomes easy for you to forecast price and also prepare yourself for setups to appear that suit or meet your entry criteria that you can then execute upon to make money from the markets. So now, once you have identified these patterns and formations in the market, it's now time to go to the third step. Now, this third step is about testing these patterns out. And now you're testing these patterns and formations out from the higher time frames down to the lower time frames to see the frequency of their formation or their appearance within the market from different time frames and how well they perform every time they appear in the different time frames all you're trying to get to is your own style of trading, whether you'll be a swing trader, a day trader, a scalper, or maybe a position trader. I wouldn't expect you to get to the point of position trading, because especially as a retail trader, that's not for you. That's for the big firms, the hedge funds, and perhaps the big banks that are trading billions of dollars on a daily, and so that's not for you. So you focus mainly on swing trading, day trading, and scalping. And so the reason you are testing these patterns out on the different time frames is so you can arrive at a trading style that suits your lifestyle better. It has to be something that fits within your daily schedule, that you know once you start trading such, you're going to be consistent with it and not be in and out every now and again. No. But you have to be consistent with it, and so you need to find a session that is suitable for you, a time that is suitable for you, a time frame that is convenient for you to be trading, that you know you're not going to miss any of such setups once they show up. And the reason why you wouldn't want to be missing is what worked yesterday today may not work, but the frequency of it working might be good when it comes to the win rate, but could be very unfortunate if today it worked out and you were not in the market, and tomorrow it so happens that it's the time that it doesn't work out and you happen to be in the markets at that time. You're going to be affecting your win rate. You want to be frequent, you want to be consistent when it comes to showing up to the markets to be trading, and so you need to sort yourself out as far as the kind of trader you would want to be. And that's why once you have spent time on the charts, made out these price patterns and formations, you want to test them out to see what suits your lifestyle. Now, moving on to the next step. Once you have tested them out, found a style that suits you, then it is time to formulate a strategy around that which you have tested out. And this strategy is going to be based on the data that you have gathered from your testing. And once you have this data and you have this strategy with you, it is then time to take it to the next step, which is practicing. Now, practicing is the holy grail of trading. It's everything when it comes to success. It is not just part of the thing. In fact, it's not just everything. It is the only thing when it comes to trading success. There are no two ways around practicing. Practicing is everything that you need in trading once you have a strategy formulated. Why? Because practicing will help you know the win rate of your strategy. It will help you know the best time to trade your strategy. It will help you know what setups bring you the most win rate. It will help you to know what to avoid in the markets. It will help you to know what times you're not supposed to be in the market. It will help you to know what risk you're supposed to be taking in the market. It will help you to know what targets you should be having as far as your trades are concerned, and that's in the form of risk reward. If let's say you're risking $1, how much are you targeting? And you want to target that which has the highest frequency of hitting. Why? Because we're looking at, trading is all about making money in the market. It's not about just staying on the charts or like treating it as a hobby. No. Trading is serious business, and so you want to know the very best target you should be looking at that has the highest frequency of hitting your winners, and that you can only tell after practicing. This is knowledge that you gain from practicing, unlike that knowledge which you gained from just looking at the charts as well as studying different people's materials or watching videos or reading certain books or even from a mentor. No. When it comes to practicing, that is the holy grail of trading. In fact, that is the basis of success. That's the foundation of success when it comes to trading. You see, once you have practiced and you know the win rate of your strategy, you know the best time it works out, you know the best setups to take, your confidence levels go high, it drives out greed from you as well as fear from you. Now, once you have tested this out, formulated a strategy out of it, practiced that strategy through simulations and backtesting and forward testing as well, then it is time for you to create a playbook. So the next step after that is creating a playbook. A playbook is simply a record of certain chart patterns with their win rate that you have graded according to their frequency of appearance as well as their strike rate. And by strike rate, I mean how profitable they are. These are setups that you have graded according to their win rate. And so the playbook is just a record of setups that you have graded. So you could grade them as 1, 2, 3, or A, B, C, D, with A being the best with the highest win rate, and B may be that which has a lower win rate, much as it is also long-term profitable, and maybe C as the last grading in your playbook. And the importance of this playbook is just simply one. It will help you to know which particular setup you should be risking more on, and which of those you should be risking perhaps just half as much as your normal risk that you would take on an A+ setup. But it is very, very important, because after you have created this playbook, when it comes to trading, you're only looking for the setups that meet the criteria in your playbook. You're only on the lookout for those setups that are included in your playbook, those patterns, the price formations, the candlestick formations, and the price patterns that are only recorded in your playbook. Everything else, you are not bothered about it. Why? Because you've not tested it out, you do not know how well it works, and trading is not about gambling. This is serious work. And so you want to be trading those setups that you have tested out, and you know how well they perform, and you have graded them in your playbook, and so you're going to be cherry picking such that are similar to those that you have actually already recorded within your playbook. So those are the steps I would recommend for you to take to become profitable trading the markets. But there are other things that you need to also add on, without which, forget it, you will not be successful trading the markets. One of them is that you have to manage your risk. You see, trading is a business. There's no business that you will do and become successful without knowing how it loses, how it makes money. You see, if I do not know how to manage my risk, then it's possible for me to make money and lose it. I'm basically a gambler and not a trader. You must manage your risk. Then secondly, trade management. You're not going to be looking for home runs, thinking that if your trade is running in profit, the profits are going to be running forever and ever. No. It's possible for you to see a trade, a position that had moved 10 times as much as you had risked, drop down again, reverse, and come back to your either break-even point, or even worse still, to your stop-out area, and you end up with a loss when you could have earned 10 times as much as you had risked. Why? Much as you were disciplined to manage risk, you were reckless by not managing your winning position. So trade management could be about you taking out profits along the way, or you trailing your stop loss as your trade is running in profits. Trade management is so paramount for your trading success. The other thing is you focusing on a few instruments in the market. Personally, what I usually do is I look at just one or two currency pairs, one index or indice, and one commodity. When it comes to currencies, I'm looking for those that are fast moving, that have volume and volatility in the market. When it comes to indices, I'm looking for one that is more stable and is not wild. When it comes to commodities, I'm looking at one that gives me the best possible opportunities to take trades almost on a daily. Now, it doesn't necessarily have to be on a daily. No. Of course, you do not force trades where there are no setups. You only trade once the setups that meet your entry criteria or your trade criteria are in place that suit your trading plan, but you want an instrument that tends to move independent of the other. For example, gold and silver. I like trading gold because of its volatility, but sometimes there are times when it tends to flow along with silver. But one thing that I've come to realize is sometimes it tends to be as though silver tends to mimic the movement of price on gold, and so I would want an instrument that is so independent of any other instrument, and if anything, it's the instrument that tends to move the other instruments and the others rotate around it, not itself rotating around the movement of other instruments. For example, when it comes to currency pairs like the yen pairs, one thing I've come to realize is a currency pair like the pound yen or GBP JPY, which is correlated to Euro JPY. When the two are giving you the same setups, it is better to take one on pound yen as opposed to the Euro yen. Why? Because the pound yen seems to be much stronger. However, when you also look at the Aussie yen or Australian dollar Japanese yen currency pair, there are times that the Aussie yen will give you better trading opportunities as opposed to the pound yen. The good thing is that they tend to move in a similar manner or fashion. However, the Euro JPY sometimes can give you false signals. It can give you false setups, and so that's a currency pair that is almost a no-go for me. But all that comes from you spending time on the charts, testing them out, practicing them out, and then formulating a strategy around them, but also taking time to look at all these different currency pairs, so you're able to pick out which currency pair usually provides you the best conditions for your strategy to work out. But hey, the point here is focus on a few instruments, and the reason why you need to focus on these few instruments is it helps you to know the ins and outs of a certain instrument. You will know the character of a certain instrument, how well it reacts to market structure. Does it respect it? Does it usually breach it? How consistent are the setups in playing out? Does it have so many fake outs? And all these you'll get to know by focusing on one or two or maybe at most 3 financial instruments for you to trade, as opposed to trading all the currency pairs on the market. The other thing to do is to focus on 1 or 2 trades in a day. You see, success is in the simplicity of things when it comes to the trading of financial instruments online. Doing less sometimes is actually more, in the sense of earnings. That the more you trade, the more you're going to overtrade, the more you're going to over leverage your account, and the more you're going to be losing. And it's possible for you to make money in a day and then see it dwindle away and fade away as the different conditions come into the market that you had maybe not foreseen, and you see your profits drained away. So it is important that once you have taken a trade a day, once the trade is successful, close the charts and call it a day. If the trade was a loser, then you could look out for a second chance entry or a second opportunity to trade. And now, regardless of how it plays out, win or lose, you close the day with maximum 2 or 3 trades in a day. That's one of the recipes for success when it comes to the trading of financial instruments online. Then the other thing is for you to focus on a particular session. For example, if let's say you're trading the US 30 or the Dow Jones, or maybe you're trading the Nasdaq, these are instruments that usually move the best during the New York session. Now, of course, you could trade some of them during the London session, but we are talking about the time when they usually play out the best. These are stock indices, and so they usually work the best when the stock market is actually open in the US. Now we are talking about the NYCE. What about the NYCE open, the New York Stock Exchange open in the US? That's the time when it usually has these instruments playing out their very best, with a lot of volatility, a lot of volume in the market, and it becomes possible and easy for you to make money off these instruments during the time when they have the best movement within the market. So it's important to focus on certain particular sessions. Now, I'm not saying that that's the only thing that you have to do for you to succeed trading these instruments, but knowing which instrument you're trading and also what time or session it usually moves the best is extremely paramount when it comes to your trading success as far as the trade of financial instruments online is concerned. Remember, this is speculative business, so you want to look at, it's all about probabilities, and so you want to look at the times when the probabilities are more stacked in your favor than not. And lastly, for now, you must have a trading plan. There are no two ways about it. There are no two ways about it. You must have a trading plan. This plan has to be one that is full of rules or certain conditions that you must see in the market before you can execute on your trades. Now, that's partly on the strategy bit, which strategy must be rules based, but it's also part of your plan. When do you trade? What instrument are you going to trade? What time are you going to trade it? How much are you supposed to be risking? How much are you supposed to be targeting? What's the risk reward that you're supposed to be targeting on every trade? When are you supposed to be managing? How are you supposed to be managing your trade? Let's say if it gets to your maybe 1-to-1, that's when you close out maybe half of your position, or maybe once it gets to 1-to-2 reward, then maybe you close out half the position and you let the rest to run. So all those are within the plan, but it has to have all the rules that you're going to be following when it comes to you trading in the market. Rules that inform your entry, rules that inform the management of the trade, and rules that inform your exit out of a position that you had running in the market. And of course, last but not least, is you keeping a journal. Now, a journal is just a record of the trades that you have taken in a particular day. Now, they may not necessarily be the trades that you've taken, could be the trades that you have missed. You need to have them journaled down. And the reason for you journaling them down is to know what mistakes you made that caused you to lose on the trade, or what did you do right for your trade to win, so the next time the same setup that you were able to profit on appears in the market, you're going to be profiting perhaps even better. You see, it's possible for you to jump out of a trade early and then see it play out to your what would have been your full take profit. But you find maybe you closed it out once it had reached 75% of your target, rather than letting it run to the full 100% of your target. And so those are the things that you record in your journal, as well as what setup it was, how did you trade it, how did you manage the trade itself, and was it profitable or was it a loss? If it lost, why did it lose? Was it about the session you traded it? Was it about the time you traded it and maybe there was news that you hadn't seen that came out and had it run to your stop loss? All those details are recorded within the journal, and that journal will help you when it comes to taking the next trade the next day. So in summary, those are some of the steps that you can take to ensure your own trading success when it comes to the trading of financial instruments online. Now, if you're new to the channel, kindly subscribe, like and share this video, and also turn on the notification so you are alerted every time I post new content online. Thanks for watching once again. I'll see you again.